In this video, we want to introduce you to one important component in financial planning in order to achieve your financial goals, which is investment planning. Before we jump more about investment planning, here I want to explain to you about investment planning, and the importance of it. Investment is an asset or item acquired to generate income or gain appreciation. Example of investment is common stock, bond, real estate, mutual funds, stockbroker, hedge funds, and asset allocation. However, investment planning is a process of determining financial goals and objectives and then distributing funds across different investment vehicles to meet this objective. The importance of investment planning cannot be overstated. It's the key to financial security, allowing us to grow our wealth, outpace inflation, and save for long-term goals like retirement. Not just about growing wealth, it's also about securing your financial future. It's the roadmap that guides us toward achieving our financial goals, whether that buying a home, saving for education, or ensuring a comfortable retirement. Effective investment planning helps us understand the balance between risk and return. It allows us to make informed decisions about where to place our money and how to protect it against the unstable market. Inflation can erode the value of our savings over time. Through investment planning, we can choose investment that not only keep pace with inflation, but potentially outpace it, preserving the purchasing power of our money.
Assalamualaikum. So I'm Khalid Daniel. I will be presenting about the power of compounding. So compounding is a process where the value of an investment increases because you earn interest on both your initial investment and the interest that has accumulated over time. There are three core ideas of compounding that you should know. So the first one is interest earned. So this basically explains that the principal earns interest or generates returns of a specific period. This could be through interest from a savings account, dividends from stocks, or capital gains from investment. The rate of return can vary based on the type of investment and the market condition. The second one is initial investment. This explains about compounding begins with an initial sum of money, known as the principal. This is the amount of money that you invest or save. The principal is the base amount upon which interest or returns are calculated. And the last one is reinvestment. Reinvestment in compounding is when the interest or earnings are not taken out but are reinvested back into the principal. This reinvested amount becomes part of the principal for the next compounding period, meaning you earn interest on both the original principal and the accumulated interest from previous periods. So, next one is key points of compounding. There are three that you should know. The first one is time critical, which means the longer the investment period, the more significant the effect of compounding. Starting early allows the investment to grow more due to the cumulative effect of interest. The second one is consistency matters. It is a regular contribution to an investment can significantly amplify the benefits of compounding. For example, investing a small amount monthly can grow into a substantial sum over time. And the last one is higher rates increase growth, which means even small increases in the interest rate can lead to significant differences over long periods. For example, a 1% increase in the interest rate can result in much larger growth over several decades. And the last one is practical applications, which means where would you possibly use the idea of compounding in your life? The first one is savings and retirement. This explains how beginning to save and investment early for retirement can result in significant growth, thereby simplifying the achievement of financial objectives. And the second one is debt. The compounding in debt will point out that it can also be detrimental when dealing with debt, as unpaid interest accumulates over time, leading to a larger amount owed.
So right now, we're gonna go into diversification and risk management. So, what is diversification and risk management? Diversification in investment refers to spreading your investment funds across different types of assets to reduce risk. It is like not putting all your eggs in one basket. By diversifying, you can lower the impact of any single investment's poor performance on your overall portfolio. Risk management, on the other hand, involves identifying, assessing, and prioritizing risk, followed by coordinated and economical application of resources to minimize, monitor, and control the probability or impact of unfortunate events. In the context of investment, risk management strategies aim to protect your investment capital and optimize returns by carefully managing potential risks associated with different investments. Why diversification is crucial? First of all, risk reduction. Investing in a mix of asset classes such as stocks, bonds, real estate, and commodities can help mitigate the impact of a downturn in any single investment. If one asset class underperforms, the other may still provide returns, balancing out your overall portfolio risk. Then, we have market volatility protection. Different asset classes react differently to market conditions. For instance, stocks may perform well during economic growth, while bonds could be more stable during market downturns. By diversifying, you can reduce the impact of market volatility on your investment. On third, we have optimized returns. Diversifications allows you to optimize returns while managing risk. By having a mix of assets with varying level of risk and returns potential, you can create a portfolio that aims to achieve a balance between growth and stability. Then we have long-term stability. A diversified portfolio is more likely to withstand market fluctuations over the long term. It can help you stay invested through various market cycles and reduce the impact of short-term market movement on your overall wealth. Lastly, you have personalized risk tolerance. Diversification also enables you to tailor your investment strategy to your risk tolerance and financial goal. By diversifying across asset classes based on your risk appetite, you can create a portfolio that aligns with your individual investment preferences. In essence, diversification is a powerful risk management tool that helps protect your investment against unforeseen events and market fluctuations. By spreading your investment across different asset classes, you can build a resilient portfolio that aims to deliver stable returns over time. It's like creating a safety net for your investment to weather various market conditions and strive for long-term financial success.
Investment strategies for different life stages. There are 4 life stages as I learned. First, ages 25 to 35, first career after graduation. In this phase, individuals embark on their first career after completing their education, focusing on establishing their professional path, gaining valuable experience, and building a robust skill set. Investment strategies during this time should prioritize growth with a focus on higher risk, higher reward options like stocks and mutual funds. Examples including investing in diversified stock index funds or growth-oriented exchange-traded funds and contributing to retirement account like individual retirement account. Second, ages 35 to 45, the golden age. During the golden age, individuals experience significant career progression, often reaching their leadership or senior position within their fields. Investment strategies should balance growth and stability, diversifying portfolios to include a mix of stocks, bonds, and real estate. Examples include investing in a balanced mutual fund, purchasing rental properties for additional income, and increasing contribution to retirement account. Third, ages 45 to 55, the mature age. The mature age brings a peak in expertise and experience, with individuals often taking on mentorship and leadership roles. Investment strategies should shift towards preserving capital and generating income with a greater emphasis on bonds, dividend-paying stocks, and other income-generating assets. Examples include investing in municipal bonds, high-dividend blue-chip stocks, and real estate investment trusts. And the last one is ages 55 and above, which is retirement period. In the retirement period, individuals transition out of full-time work, dedicating more time to leisure, hobbies, and personal interests. Investment strategies should prioritize capital preservation and income, focusing on low-risk investments like bonds, annuities, and conservative mutual funds. Examples include investing in fixed annuities, treasury bonds, and low-risk mutual funds or exchange-traded funds designed for retirees.
For summary, investment planning involves creating personalized strategies to achieve financial goals. Factors like risk tolerance, time horizon, and diversification play a crucial role. Remember to choose a legal and trusty investment. You can check the list of legal company in Malaysia on the webpage of the Security Commission Malaysia. What I can suggest to you is Robert Advisor if you are a beginner or busy investor. Robert Advisors such as Wahid Investment and Rais have an AI that helps you to choose your portfolio. Last but not least, investment planning is personalized. Always seek professional advice for your own investment planning. Remember, goals plus strategy equal with financial success.